Intermediate Accounting, Chapter 11A, Appendix, Depreciation and Income Tax. Appendix 11A, Depreciation and Income Tax. Canadian businesses use the Capital Cost Allowance, CCA method, to determine depreciation and calculating their taxable income and the income tax values of their assets. Because companies use this method for tax purposes, some, to reduce costs, also use it for financial reporting, but it may not be justifiable under GAAP. Most companies keep a record of capital cost allowance for tax purposes and use another method to determine depreciation for financial reporting purposes. Capital Cost Allowance 104. Capital Cost Allowance is a diminishing balance approach similar to the declining balance method. It's not depreciation expense, it's referred to as CCA. Income Tax Act identifies several classes of assets and specifies the maximum CCA rate for each class. CCA is calculated separately for each asset class and is claimed on fiscal year-end amounts in each class. Maximum CCA allowed is the undepreciated capital cost, UCC, at year-end times CC rate for that class. Capital Cost Allowance 204. Until late 2018, for net additions, the maximum CCA rate for the net addition was 1/2 of the allowed CCA rate. This was called the half-year rule. On November 20th, 2018, a change was introduced suspending the half-year rule and allowing a first-year deduction of 1.5 times the standard CCA rate for eligible property. In addition, manufacturing and processing, M&P, and specified clean energy equipment is allowed 100% write-off. The new rules, known as the Accelerated Investment Incentive, apply to property available for use in 2024, phasing out between 2024 to 28. Capital Cost Allowance 3 of 4. CCA can be taken even if it brings the UCC balance to less than residual value. Companies are not required to take CCA for tax purposes, although they normally would if they have taxable income. If CCA claimed is not the maximum in 1 year, the balance cannot be added in any subsequent years. The UCC at any point is known as the capital asset's tax value or tax basis, may be different from carrying amount. Capital Cost Allowance 4 of 4. Income Tax Act requires any benefits a company receives from government grants be deducted from the cost, and any investment tax credits reduce the UCC in the following year. When an asset's disposal eliminates the asset class, either because there are no more assets remaining in the class or because the disposal results in the elimination of the UCC balance of the class, the following may occur. There may be a recapture of CCA with or without a capital gain. There may be a terminal loss with or without a capital gain. Capital Cost Allowance, examples 1 of 2. Assume the following for Big Quip Company's March 28, 2020 acquisition of manufacturing equipment. Its only asset in this class is 20% rate, Class 8, and is subject to the Accelerated Investment Incentive. The cost of equipment is $500,000, the estimated useful life is 10 years, and the estimated residual value is $30,000. So on January 1st, 2020, the opening UCC balance was 0. The cost of the new asset was $500,000. The CCA for the first year at the accelerated 1.5 rate is $150,000, and the ending balance in 2020 is $350,000. Then the CCA rate in 2021 is the $350 times 20%. That gives you CCA of $70,000. And so the new UCC balance at December 31st is $280,000. Then in 2022, you take CCA of $56,000, and your ending UCC balance at the end of December 31st, 2022 is $224,000. Capital cost allowance examples 2 of 2. In 2023, BQ purchased another Class 8 asset for $700,000 with CCA based on the accelerated investment incentive. So then December 31st, 2022, you have your opening UCC of $224,000 and CCA on that amount at 20% for $44,800. And then you have your new asset of $700,000 and CCA at 1.5 using the accelerated investment incentive is $210,000. And your ending December 31st, 2023 balance is $669,200. In 2024, BQ sold for $300,000 equipment purchased in 2020, cost $500,000. So manufacturing equipment originally purchased in 2020 would be the lesser of the original cost of $500,000 and proceeds of disposal of $300,000. That's just a tax rule. So we'll subtract the $300,000 to give you $369,200. CCA on that amount at 20% is $73,840 for an amount of $295,360 as at December 31st, 2024. In 2025, BQ sold the remaining asset for $500,000. No Class 8 asset remains. So in December 2025, the lesser of original cost of $700,000 and proceeds of $500,000 is $500,000 to get a balance of negative $204,640. And this will be considered recapture for 2025 of $204,640 for an ending balance at December 31st, 2025 of 0. The end.